Hello everybody, Nation Sale Jackson CPA PFS here. So we're here today to talk about various accounts that you can have for your child and what that means in terms of investing for your child's future, whether that's for retirement, for school, like college, or even high school, if you want to do like a private school or charter school, or just generally for their future, just to kind of give some money away to them. So we're going to talk through some various options and tools that are available to you. So stay tuned. We're going to be right back in a second. All right, everybody, and we're back. So thanks again for tuning in today. So today we're talking about accounts that are available for your children to invest for their future. All right, so we're talking about various accounts that are available for them. So the first one available is just a basic checking or savings account, okay? Various places allow you to open them for your children. Depending on how old they are, there's certain places that allow it and certain places that won't. So older they are, obviously, the more easy it'd be for you to open these types of accounts. The younger, the harder it might be for that bank to open the account for you, okay? But basically what you need is an account in their name. I generally recommend somewhere that's gonna give you at least a 2% savings rate on a savings account if you wanna use some of the money for a savings account in there. But keep in mind, this is not an investment account, okay? This is an account that you use just purely to store some short-term cash for the benefit of the child, or to like transfer some funds to them or some way, shape, or form, okay? So it's just an intermediary account essentially, and don't plan to use it on a long-term basis, okay? You need to have some other investment vehicles, which we're going to talk about here in a second. Okay. The next thing that's available to you is, if you have a business, we talk about all the time, is paying your kids, like my shirt says, from your business. Put your kids on the payroll. Okay. And I'm not going to go into detail on how to do that. Just keep in mind that there's different strategies depending on how your business is structured. But in a nutshell, what you're doing is you're taking money from your business and giving it to your child for doing legitimate work in the business, not just paying them to pay them. Okay, so you got to have a time log, you got to have a reasonable hourly rate, you're paying them at least monthly like you would any other employee, that kind of stuff. Okay, so have yourself like a good setup if you're going to do this strategy on paying your kids from your business, and make sure you're following all the rules. So work with a professional that understands it, or take a look, and even take a look at my video that I talk about this in detail about, and just learn the strategy a little bit, okay? So that's paying your kids. Now, that checking your savings account that we just talked about is an important component of that strategy, and so you'll need to have that open to be able to pay the kids, because one of the requirements is you do have to pay your kids into an account in their name, okay? So keep that in mind. All right, now let's talk about some other things, okay? Now, for these other accounts, for paying your kids, the gift tax rule doesn't really matter, okay? Now, when it comes to gifting your child money, okay, you have to keep in mind that the max you can gift them is $19,000 a year, okay? Or if you're married with a spouse, $38,000 a year, okay? You cannot gift them any more than that without eating into your lifetime exemption. So I'm not saying you can't do it, but if you do it, then you're gonna start to eat into that lifetime exemption that you have, which roughly right now is about $15 million for each, you and your spouse, okay? So 30 million total is what it is right now. And so important to note that if you do more than $19,000, you will start to eat into that. And that's $19,000 per child. So if you have 3 children, that's $19,000 for each child. 2 children, same thing. So just each individual person, okay? So if you put money into a savings account, for example, that's coming out of that $19,000. If you put money into this next type of account called the UGMA or UTMA, that's also going to be coming out of that account, or that $19,000, okay? Now, the UGMA and UTMA, it's just an investment brokerage that's a taxable brokerage. It's taxable at your child's income tax rates unless they make enough unearned income to where they are going to be taxed at your rate if you have a much higher rate than they do. It's called the kiddie tax, okay? So keep that in mind, that if you do the UGMA or UTMA, be careful on what you're investing in, that it's not spitting off annual income too much, because the more annual income it has, like dividends and interest, the more taxable it's going to be at your current income tax rates. Okay, so something to kind of keep in mind there. That's pretty much it on the UGMA or UTMAs. There's some other things that you maybe want to kind of think about. There's a slight difference between those two accounts. One of them allows you to do things other than just stocks. The other one basically limits you just stocks. So like other things like real estate and some other investments that you could put into one of those accounts. Okay. So just kind of keep that in mind. All right. Next account is a 529 plan. Okay. A 529 education savings account. Okay. So these are available for educational purposes. You can have one for each child. You can even have one for yourself, technically. And basically, it's a way just to save for your future or your child's future education. Okay, so you name a beneficiary on the account, you gift money into it. It's kind of a gray area because you kind of still own it, but it's deemed actually a gift to the beneficiary. So you still have some control over the account, though, to where you can change beneficiaries and stuff like that. So just kind of keep that in mind. It is kind of flexible in that regard. The earnings in that account are going to be tax-free as long as the money is pulled out for educational purposes. If it's pulled out for something other than that, then you do pay taxes on those earnings. Plus, there's a penalty associated with that as well. So just kind of keep that in mind, not to put too much into the 529 plan that you don't think will actually be used by one or more of your kids. The nice thing is you can switch it between kids. So let's say you have a child that doesn't end up going to school, but you do have one that went to school and it's a little bit more than you thought. You can use the money in the other child's 529 to go ahead and cover the cost of the school for the other kid. So kind of flexible in that direction. Now, I generally don't like 529 plans, as you've heard me say on other videos, because the investment choices are not that great, okay? So I prefer something called a Coverdell ESA, Coverdell Education Savings Account, which is the next type of account that you can invest with your kids or for your kids' future. And this one's also for educational purposes. It's also got tax-free growth. The main difference is it's limited to only $2,000 per year. Okay, so I would definitely encourage you to do the Coverdell ESA first, and then if you still want to put more money towards their education, then you can look at doing a 529. But really, to me, I'd go to the UGMA or UTMA because that ultimately is a lot more flexible and you have a lot more investment choices with the UGMA or UTMA than you do a 529 plan. So it takes care of that investment issue and you get those greater returns, hopefully, depending on, as long as you don't buy something silly in those accounts and it decreases in value, then you should have some much better returns, which ultimately will be more beneficial to you. Okay, even though it's not tax favored or tax-free growth, it's still going to have some good returns and more flexible to use. Okay, so the Coverdell USA I think is great. It's a great tool that's available for kids. There is an income limit for it, but you can get around that several ways. One way, gift the child into their savings account, the education savings funds, or the amount for the educational savings account, and then have them put it into the ESA. That's the easiest way to get around it. Another way to get around it, if you have a business, the business can contribute to it. Just keep in mind, if you do that, you do technically have to do that for your other employees as well. So if you have other employees, something also kind of keep in mind there. Grandparents or aunts, uncles, stuff like that, you can give the money to them and they can contribute on your behalf if they have lower incomes. So there's a few different ways to get around that income threshold if your income's too high. So don't think that you can't get around it some way, shape, or form. Okay, that's Coverdell ESA. I forgot about one of the most advantageous ones, the Roth IRA. So one of the perks of paying your kids, right, through the business, or even them having earned income from other sources, not only your business, but other earned income sources like babysitting, landscaping, house cleaning for people, et cetera, right? There's any number of ways they can get some earned income. So if they have earned income, now what can they do? Dun, 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 they can put money to a Roth IRA. What's the greatest benefit of doing that? Being under 18, likely they paid no income taxes, no payroll taxes, and the money's going to grow tax-free. I mean, come on. What other account do you think of that's going to be able to do that? Okay, there's one other account that can do that. It's called the health savings account, but that's really only available if you have like a high deductible health plan, which kids under 18 are not going to be worrying about that kind of thing. Okay, so anyways, but I mean, come on. The Roth IRA is kind of cool, right? Especially for kids. So under 18, it's a custodial account. So you still have control over how it's invested and all that good stuff. A lot of investment options that are available to you. So I love the Roth IRA. Both the Roth IRA and the Coverdell ESA, by the way, can be self-directed into a self-directed retirement account type place like directed IRA. And you can then use those funds to invest in things like cryptocurrency, Bitcoin, whatever you want to kind of do, right? Even though right now it's having some turmoil and some turbulations, I mean, eventually it'll probably go back up, right? Nobody knows for sure, but I suspect that it probably will, right? So don't come at me if it doesn't happen, but I think everyone from all the experts that are out there, they believe it'll go back up at some point. So that's what we're going to say, okay? So that said, just a lot more flexibility with the Roth IRA. So great tool that's available to you. okay? Then you have the Trump accounts. That's the new one that's going to start July 4th of this year. I've done a video more in detail on the Trump accounts and things to consider in regards to that, in terms of how to do it, all that kind of stuff. A few just really high level important things. On your 2025 tax return, okay? Very important. And all you CPAs and tax pros out there, if you are not asking your client this question, I'm irritated with you, because you should be doing it, okay? This should be a question that's on your tax organizer, and you should be asking the client this question. For your child's and for your children, do you want to open up a Trump account, okay? Because it's a simple form on the tax return rather than them having to figure out what to do later on, okay? So they fill out the form, 4547, Trump account automatically opened once we get to, you know, July, or maybe even before, but certainly by July 4th of 2026, account's gonna be open. And if they were born during that time period where they get the free $1,000, that's gonna be deposited into that account, okay? If they're not born in that time period, then you can still contribute to it after July 4th of 2026, okay? So something to look at there. I'm gonna go to one of my videos that are more detailed on what you can do, how you can fund it, all that kind of stuff, some of the rules. I have another one that's gonna be coming out either before or after this video here. So go and check that one out. It's a lot more detailed than my first one that I did. Pretty awesome stuff though, okay? Trump accounts, I've come to like more than I initially did when they were first talked about in some of the original drafts of the bill. I think they're a lot better now than what they were originally. And I think it's a great tool to add to the coffers to save for your child's future and kind of force some savings upon them, and then hopefully educate them on what to do so that they continue to save even beyond the age of 18. So a lot of these accounts that we're talking about here, at age 18, it becomes theirs, so they can do whatever they want. The one exception to that would be the 529 plan. That technically you can still remain the administrator of the 529 plan, but the UGMA, UTMAs, the Roth IRAs, and the Trump accounts, those all become like their accounts at the age of 18. And so the 529s and the Coverdales are the ones that you can kind of still maintain some ownership over until they get distributed. So just kind of keep that in mind, guys, that you got to start educating your kids on what to do with these accounts. Don't just give them the money and say, okay, figure it out. Educate them. Give them some advice and thoughts and help them grow. Okay, so the Trump account is also cool because literally, if all you got was $1,000 and they kept it in there until age 60, they could end up with like $524,000 in that account, assuming a 11% average annual return, blah, 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 right? But they could end up with a pretty sizable account just off $1,000, all right? And if you add a little bit more to it, it just exponentially grows from there. So go check out my video. I went through all a few different scenarios and stuff like that that are out there. So check that out, okay? So with a couple minutes left here, let's talk about order of priority, okay? This is just my personal recommendation that I'm generally thinking about for a lot of my clients. You know, you can do whatever you want, right? But here's how I kind of think about my level of priority for these accounts. So if eligible, first thing I'm doing, maxing out the Roth IRA. Most versatile, most tax advantage, most superior account out of all these accounts. I'm maxing out that Roth IRA first and foremost. Second, I'm gonna go to the Coverdale ESA, okay? That's generally gonna be the second option that I'm gonna go to because it helps save for education. It could be used on high school, private school, college, pretty much any education component. So I'm gonna go to the Coverdale ESA next, okay? Then I'm gonna go to Trump accounts probably. Okay, so I'm gonna go to the Trump accounts next. It's gonna be the next place I'm gonna go. And I'm gonna put some money into that, okay? After the Trump accounts, we're going to the UGMA or UTMA, all right, custodial brokerage account. We're gonna go to one of those. We're gonna put some money into that, okay? And then if you really wanted to put some more money into an education account, then we're gonna, as a last priority, put some money into a 529 plan, okay? Again, yes, this is how much I don't like 529 plans. It's on the bottom of my list, okay? So I'm just not a huge fan of 529s. Just not, all right? So as long as you have a good investment strategy with your Coverdale, with the UGMA, UTMAs, all that kind of stuff, you don't really need a 529 plan, honestly. Now, if you have a higher net worth and you want to save for education accounts for generations beyond, there is a really cool strategy using 529 plans where you max them out, you let them sit there, you let them grow. They're available to transfer between beneficiaries, grandkids, great-grandkids, etc. That's actually a really cool strategy that's out there. It's available. But unless you're doing that, I'm not really a huge fan of the 529s, okay? So just kind of keep that in mind. Now, if you do 529, We need to make sure you're finding the coolest account that's out there that's going to give you the best returns. Keep an eye on it. You're always monitoring it, making sure it's performing well. If it's not, then you're going to switch it and move it around to a different plan or something like that, right? So we got to kind of be careful with the 529s. Okay? All right, everybody, that's the video for today. Thanks for tuning in. If you have any questions or comments, please leave them down below. Go check out the video on Rumble, YouTube, subscribe to our Rumble, YouTube, X platforms, etc. We post the full videos on those, so check them out there. Share them with your friends or family if you thought this was helpful to you. And yeah, let's talk some more about how to build some wealth for yourself and your kids. So stay tuned for more cool videos coming up. Peace.
This presentation is intended to be educational only and does not constitute a CPA or financial advisor-client relationship. It is always in your best interest to consult a competent legal financial advisor and/or tax professional when conducting your own personal transactions. Furthermore, it's important to do your own research when necessary to verify tax law when there's a lack of concrete guidance or gray areas of conversation.